In this module, we're going to look at goodwill, and that's partial goodwill and full goodwill, and we're also going to look at the impairment of goodwill. Okay, before we get to that, we've got a little bit about statutory definitions of mergers, acquisition and consolidation, and variable interest entities. I'm not wildly excited by this. I think it's very unlikely that the exam will test us on these definitions. But notice, a merger, Company A and Company B come together, but only Company A survives. In other words, what we're talking about in a merger here is the transfer of assets from Company B into Company A. So the net assets are transferred from Company B into Company A, and then essentially Company B ceases to exist. Under acquisition methods, and of course this is what we've been really talking about here, two companies come together. One is going to be the parent and the other is going to be the subsidiary. Now notice they also talk about consolidation here, and when they mean consolidation, you've got Company A and Company B combining to form a brand new entity, and that brand new entity is Company C, essentially. So Company A's and B cease to exist and a new entity is created. Finally, we've got variable interest entities, and you can see a variable interest entity is any entity where control is not based on equity ownership. Now, we might refer to these as special purpose vehicles. US GAAP often refers to them as variable interest entities. And that's because control is exercised via a variable interest rather than share capital. We'll have a look at those in a future module. Okay, so let's turn our attention to goodwill for the rest of this module. Okay, so Wood Corporation paid 600 million for all of the outstanding stock of Pine Corporation. So all of the outstanding stock, so we've got 100% of the share capital, and of course that means no minority interests. At the acquisition date, Pine reported the following balance sheet amounts. So notice in our subsidiary, and this is the subsidiary's accounts, we've got its current assets of 80 million, its net PP&E, so that would typically be the cost of your PP&E less accumulated depreciation. We've got goodwill, so obviously Pine, the subsidiary, has invested in other companies in the past, has invested in other subsidiaries. Okay, and that's the goodwill that it's sitting in the subsidiary's balance sheet. We've got liabilities of 400 and stockholders' equity of 470. Now be aware that goodwill is not an identifiable asset. And remember, you learnt this at level 1. We talked about identifiable assets and unidentifiable assets, and goodwill was an unidentifiable asset because it couldn't be separately detached from the company and sold. Now remember, when we produce the consolidated group accounts, when we look at our subsidiary, we bring in the fair market value of net assets that are identifiable. So in other words, when it comes to this, when it comes to the consolidation, we're going to ignore this goodwill figure. It excludes this goodwill figure. Okay, so let's have a little look then at our goodwill computation. Now it tells us as well that the fair value of PP&E was 120 million above book value. Okay, so we've got a fair market value adjustment to our plant, property and equipment made at the date of acquisition. The fair value of all other identifiable assets and liabilities was equal to their book value. So compute goodwill. So there's the purchase price, what we paid to acquire the subsidiary. We're then looking at the book value of its net assets. Well, let's just return to the previous slide and look at its net assets. We've got the current assets of 80, we've got the net PP&E of 760, and we've got the liabilities of 400. We do not include that goodwill because it is not an identifiable asset in the subsidiary. So we've got 80 plus 760 minus 400. Okay, so we've got 440. Now notice, of course, if we did include the goodwill, the figure would have been 470, the same as stockholders' equity, but we don't include that goodwill. So there you go. Note, using the 440 figure, not 470, because of the exclusion of that goodwill. Now, of course, When we look at the net assets that we've acquired, we look at the fair market value of net assets. So there's a fair market value adjustment to our plant, property and equipment. And that's going to increase, of course, the fair market value of net identifiable assets from 440 up to 560. So we're going to add those together to get our 560 figure. Now remember, we own 100% of this company, so we bring in 100%, of course, of the fair market value identifiable net assets. Remember, if you own less than 100% of the company, then if you only own, let's say, 80%, you'd bring in 80% of the fair market value net identifiable assets. But here we own 100, so we're going to deduct the 560. So we've paid 600 million, we've acquired fair market value identifiable net assets of 560 million, and the difference between what we paid and what we acquired is, of course, our goodwill figure. So in this case, we've got a goodwill figure appearing in the group accounts of 40 million. Now, partial and full goodwill. Now, what I would say first of all is if you're looking at acquiring 100% of share capital, there is no difference between partial and full goodwill. So it's only going to be an issue when we're looking at acquisitions of less than 100% of the equity in a subsidiary. Okay, so US GAAP requires full goodwill. IFRS permits full or partial goodwill. Now, actually, what we did with equity accounting for our associates is partial goodwill. Okay, so we already know the computation of partial goodwill. We're going to compare the purchase price to our share of fair market value identifiable net assets. So there you are. Goodwill is the purchase price, what you paid to acquire the subsidiary, minus your share. So if you owned 80% of the equity capital, you take 80% of the fair market value of net identifiable assets. Okay, and again, there's that phrase identifiable. So remember, if you see goodwill sitting in the subsidiary, that's going to be ignored. It's not a separately identifiable asset. Okay, and of course, when we look at non-controlling interests, essentially what we did then is we looked at the fair market value of net identifiable assets times the percentage owned by the minority shareholders, so not owned by our shareholders. Okay, so we've been doing partial goodwill up until now. What about full goodwill? Now remember, full goodwill is required under US GAAP, but IFRS allows you either to use full or partial. Well, full goodwill is going to be the fair value of the subsidiary, think market value of the subsidiary, minus the fair value of identifiable net assets. So slightly different terminology. Remember, with partial goodwill, we didn't talk about the fair value of the subsidiary, we talked about the purchase price. And of course, when we looked at the identifiable net assets, under partial goodwill, we talked about our share of net identifiable net assets. Now, therefore, essentially, if you're looking at acquiring 100% of the share capital, these two things would be the same, and these two things would be the same. So full and partial goodwill is identical if you acquire 100% of the share capital. However, if you're acquiring less than 100% of share capital, then purchase price is not the same as fair value. Net identifiable assets is not the same as our share of net identifiable net assets. Okay, now it means as well that we calculate the non-controlling interest slightly differently under full goodwill. We have to. If goodwill's been calculated differently, then the minority interest needs to be calculated differently to keep the balance sheet balancing. So notice the non-controlling interest is the minority share. So again, if we owned 80%, the minority would own 20%. So it would be that 20% times the fair value of the subsidiary. Right, okay, let's get into an example and try and see how this works. So, continuing our previous example, suppose Wood paid 450 million for a 75% share of Pine. Compute goodwill under full and partial methods. First thing we need to do if we're thinking about the full goodwill method is work out the fair value of the subsidiary. And we do this simply by grossing up. Now, we've paid 450 million for 75% of the company. So if we take that 450 million and divide by 0.75, then it's telling us 100% of the company must have been worth 600 million. Okay, in other words, 450 million represents 75% of the company, and therefore 600 million represents 100% of the company. So that's the fair value of the subsidiary. We've also been given the fair value of the identifiable net assets, in other words, identifiable assets minus identifiable liabilities, and that was 560. Okay, so full goodwill, of course, therefore, is 600 minus 560, and that gives us 40. But remember, with partial goodwill, what we're going to do is we're going to look at, under partial goodwill, we're going to look at purchase price. So that's 450 million compared to our share of fair market value, identifiable net assets. So if the identifiable net assets, if 100% was 560, we're going to bring in our share of that, 75% of 560, and that gives us a figure of 420, and therefore a goodwill figure of 30 million. Now notice as well, we're saying it's actually very easy to go between partial and full goodwill. I've got the partial goodwill here, and let's say I want to get to full goodwill. Well, let's take the partial goodwill and say, okay, that's 30 million, divide it by 0.75. So 30 divided by 0.75, and lo and behold, that gives us the 40 million. Or alternatively, of course, we could take the full goodwill, 40 million, multiply by our share, 0.75, to get partial goodwill. So it's easy to move between full and partial goodwill in the exam. Okay, so you can see the calculations here very clearly. Our full goodwill being the fair value of the subsidiary minus the 100% of fair market value net assets. Whereas partial goodwill, you can see it as price paid compared to our share of fair market value net assets. Okay. And you can see the difference, 40 million, 30 million, under full goodwill, therefore our goodwill in this example is 10 million higher. Now if our goodwill is 10 million higher, that means our balance sheet assets are 10 million higher. Now of course, remember the balance sheet equation, assets equals liabilities plus equity. If your assets are 10 million higher, either your liabilities or your stockholders' equity will need to be 10 million higher to keep the balance sheet balancing. And actually, as we've said before, it's the equity. We're going to make an adjustment in our minority interest. So look at the non-controlling interest under full goodwill. We take the fair value of the subsidiary, multiplied by the minority stake, 25, and that gives us a non-controlling interest here of 150 million. Okay, under partial goodwill, again, we're going to take the minority stake, but we're not going to multiply by fair value. We're going to multiply by essentially the fair market value of net assets. Okay, so that's the 560 figure giving us 140 million. Well, notice the difference between the goodwill essentially is 10 million, and the difference between the minority interest is 10 million, which keeps essentially our balance sheet balancing. Again, as we said earlier, look, if you're looking at 100% owned subsidiaries, then essentially there is no difference between the two methods. You might remember from level 1 that goodwill is not amortized, but instead it's tested for impairment annually. And we have to do that test for impairment annually, whether we believe there's been an impairment or not. So it's a mandatory test. Okay, it's not just if you think there's been an impairment, we have to do it. Now, as we said, goodwill cannot be separated from the overall business. It's not an identifiable asset in its own right. So when do we have an impairment? Well, we have an impairment when the carrying value of the business unit is greater than its fair value. Okay, remember, what does carrying value of a business unit mean? Carrying value of your business unit is the balance sheet value of the subsidiary that you've got included in your group accounts. What have we got included in our group accounts? Well, we've got the goodwill figure, okay? And of course we've got its assets and liabilities, so plus its net assets. That is the carrying value of the subsidiary. And we're saying if the combination of goodwill plus the net assets of the subsidiary are bigger than the fair value of the subsidiary, then essentially we have an impairment and we're going to have to write down our goodwill. Now remember, impairments go through the income statement. They're rather like giant depreciation charges, essentially. So the impairment is going to reduce the balance sheet asset, the goodwill in the balance sheet. The other side of the impairment is going to appear as an expense in the income statement. And remember, typically they were unusual or infrequent items within our income statement. Now, goodwill impairments cannot be reversed. No surprise under US GAAP. Again, if you remember back to level 1, typically US GAAP did not allow you to reverse impairments full stop. There was one exception to that, and that was assets held for sale. But typically US GAAP did not allow you to reverse impairments, primarily because US GAAP is worried about earnings management. It's worried about you creating an impairment in one year. Okay, in particular, maybe we've got a very good year and earnings are high this year, but we're worried about earnings being lower next year. So we impair the asset this year, which reduces this year's earnings, then reverse the impairment in the subsequent year that boosts future earnings. So US GAAP is worried about impairments being used for earnings management, therefore it shuts down that road, it doesn't allow you to reverse. But typically IFRS did allow you to reverse impairments. But we've seen the impairments for equity accounted investments and now the impairments for goodwill cannot be reversed under IFRS as well. So why does IFRS take this view? I think IFRS is taking this view simply because of the difficulty in establishing the fair value of a subsidiary. It's a very subjective figure, and therefore the danger would be if we could impair these and then reverse the impairment because of that subjectivity in fair value. It would be very easy to use this to distort the accounts. So even IFRS shuts down this road and says no. Once you've got an impairment of goodwill, it's permanent. You cannot reverse it in subsequent periods. This little point here, it says essentially IFRS allocated across cash generating units that will benefit from the acquisition. What does this mean? Well, look, what we're really talking about is the segmental disclosure in a group accounts. You might remember again from level 1 that if you've got divisions that contribute to 10% of sales, 10% of operating profits or 10% of asset use, then we need separate disclosure of these divisions in our segmental disclosure. So what they're talking about here is not affecting the consolidated income statement, okay? It's affecting the segmental disclosure in the accounts. If we've got this impairment, the idea is we have to share the impairment in the income statements of all of the cash generating units that benefited from the acquisition. In other words, all the cash generating units that had synergies from the acquisition. So all of them are going to suffer. They're going to see some of the impairment of this goodwill passing through their segmental accounts. US GAAP, similar idea. It says allocated across all reporting units, essentially, which could be an operating segment or a component. So largely the same idea. Now, let's get into the mechanics of looking at an impairment. IFRS, just like level 1, takes a one-step process. It's going to compare the recoverable amount of the cash generating unit to the carrying value. Now again, remember what the carrying value is. It's essentially the goodwill figure plus the fair market value net assets. Okay, so all of the goodwill and the assets and liabilities that relate to the subsidiary that are included in the group accounts. Okay, so it talks about this recoverable amount. Now, recoverable amount under IFRS is the higher of two amounts. So it's going to be the higher of number 1, selling price minus any costs you would incur in making a sale. So essentially net disposal value. And number 2, value in use. And you might remember those phrases from your level 1 financial reporting analysis. What is value in use? It's the present value of the future cash flows that the subsidiary is going to generate. Now, of course, that is hugely subjective. How do we know what the future cash flows our subsidiary generates will be? Well, again, it's going to be estimation, isn't it? So very, very subjective. We take the higher of those two amounts, and if the recoverable amount is lower than the carrying value, then the difference is our impairment. Now, US GAAP takes a two-step process. It looks at the fair value of the reporting unit, so essentially the value you could dispose of it. So really the selling price, okay, and remember, US GAAP typically does not deduct disposal costs. So it'd look at the selling price of the reporting unit compared to its carrying value. Again, same definition of carrying value, that's going to be the goodwill plus the fair market value net assets of the subsidiary included in the group accounts. Now, that's step 1 of US GAAP. That just tells you whether you've got an impairment if fair value is lower than carrying value. Step 2 goes on to measure the impairment. Now, when we measure the impairment, what we're going to do is look at the goodwill that was reported compared to the current fair value of the unit's goodwill. In other words, what we're going to do under US GAAP is compare the original goodwill figure at the date of acquisition to a new goodwill figure, the goodwill at this point in the subsidiary's life. One last point to mention. The impairment could be bigger than the carrying value of goodwill in the balance sheet. How do we deal with this? So notice if the impairment loss is greater than the unit goodwill in the balance sheet, then essentially what you do is you write down the goodwill under IFRS down to 0, but the remainder of the loss is actually deducted from other non-cash assets of the unit. So in other words, we actually reduce the value of other non-cash assets. What do we mean non-cash assets? Well, typically it's going to be other intangibles and plant, property and equipment of our subsidiary. So first of all, eliminate goodwill down to 0, and if your impairment loss is bigger than that, then any excess is netted off against the non-cash assets. US GAAP, slightly different approach. Here, if the impairment loss is bigger than unit goodwill, then we eliminate unit goodwill, bring it down to 0, and essentially the excess we simply forget about. Okay, so we don't go and then reduce the carrying value of other non-cash assets. Now, as we said, under both US GAAP and IFRS, impairment losses are going to hit the income statement as a separate line item. And you'll remember that these were one of our unusual or infrequent items that we had in our level 1 syllabus. So let's turn our attention now to the example. So last year, parent company acquired the subsidiary for 1 million. On the date of acquisition, the fair value of subsidiaries' identifiable net assets was 800,000. So we bought them for 1 million. The fair market value of its identifiable net assets, 800,000. Okay, I'm assuming it's 100% acquisition here because we're not told otherwise, and therefore the goodwill, 1 million less 800,000, 200,000. At the end of the current year, the fair value of the subsidiary is estimated to be 950,000. The fair value of its net assets, 775,000, and the carrying value of the subsidiary, including the goodwill figure, is 980,000. Determine the impairment loss under IFRS and US GAAP. Okay, so first of all, let's start off with the original goodwill calculation. So we acquired it by spending 1 million. The fair market value of identifiable net assets we acquired, 800,000, and therefore the goodwill figure that we reported initially at the date of acquisition, 200,000. Next thing is the current period, isn't it? So we're told that the carrying value of the subsidiary, so that's its fair market value net assets plus the goodwill figure, is 980,000. Okay, so we've got a 980,000 figure essentially here. That 980,000 is bigger than its fair value. We're told that the fair value of the subsidiary is estimated to be 950,000. So of course, fair value lower than carrying value, we've got an impairment. Now, of course, IFRS would measure that impairment as the difference in the two figures. 980 compared to 950, IFRS would show an impairment of 30,000. So IFRS would take our 200,000 goodwill, it would reduce it to 170,000, and the 30,000 loss, of course, would go through the income statement as an unusual or infrequent item. Now, under US GAAP, remember, comparing carrying value to fair value just allows you to identify that there's been an impairment. We then move to step 2 under US GAAP, which is measuring the impairment. So here is our original goodwill. What we now do is we recalculate goodwill at the current point in time. Now, we're told in the question that the fair value of the subsidiary is estimated to be 950,000, and we're told the fair value of its net assets at this point in time is 775,000. So if essentially you were to calculate goodwill right now, 950 minus 775 gives us 175,000. Okay, now, of course, our impairment loss, therefore, under US GAAP, compare the original goodwill, the 200,000, to the implied goodwill at the current balance sheet date, 175,000. 200 minus 175,000 gives us an impairment loss of 25,000. So again, we'll reduce the goodwill from 200,000 down to 175,000 in the group balance sheet. And in the group income statement, there will be an impairment loss, again in unusual or infrequent items, for 25,000, reducing our earnings. One last thing to talk about, what about negative goodwill? What about purchasing a subsidiary for less than the fair market value of its net assets? Now, I think first of all, we should say, hey, this is very odd. Why would somebody be selling you a subsidiary for less than the fair market value of its net assets? Surely they would be better off just breaking the company off, selling off its assets, paying down the liability to actually generate the fair market value of net assets. Surely that would be the way to go rather than selling it for a lower figure. So first of all, US GAAP and IFRS say, hey, look, if you think you've got negative goodwill, go back to the fair market value adjustments that you made to net assets at the date of acquisition and ask yourself, did you get those right? Okay. Now, if you decide that, yeah, the fair market value of net assets was absolutely perfect, then you would conclude, I really do have negative goodwill. Now, the issue is here, we can't show a negative intangible asset. So both US GAAP and IFRS have the same approach here. If you've got negative goodwill, immediately we take it as a gain into our income statement. So it's going to affect earnings in the period of acquisition.